Hello, everyone, and welcome to today's Institutional Access webinar, a macro investor's take on Bitcoin. Today's episode is made possible by BitGo. I'd like to invite our speakers to unmute their lines and turn on video. During the webinar, please submit your questions to our speakers through the Q&A button at the bottom of your screen. We'll save some time at the end of the discussion to answer these. The session will be available on demand. All registrants will receive an email once the recording is live. I'd now like to turn the event over to BitGo's Chief Revenue Officer, Pete Najarian. Pete, please go ahead.
Thanks, Julie. And if you're responsible for the music selection every time at the intro, thank you. Those are always great. Hello, everyone, and welcome. I'm Pete Najarian. I am the Chief Revenue Officer at BitGo. We want to thank you for joining us. We hope everyone is healthy and safe, you and your families. We've been partnering with Blockworks Group to bring together this series, and we think it's been absolutely fantastic. It's been the most relevant institutional investors participating in crypto, and it's been really quite a robust series with great feedback, so thank you. Today we're discussing a macro investor's take on Bitcoin, which I think personally think is a terrific topic. A quick BitGo plug. We are the first to launch a complete front-to-back solution that allows a full stack, one-stop platform for liquidity, insured custody, crypto lending, portfolio and tax tools all in a single secured environment. So we believe that's what the market demands. We listen to our customers, and that's how we got here. And we are fully launched and live, and it's building quite rapidly. Again, excited to be part of this. We think the Blockworks team's done a great job, and we think we have some fantastic speakers today. And with that, I'll turn it over to Michael, Michael from Blockworks to introduce the speakers and get us started.
Awesome. Thanks a lot, Pete. And again, a big thank you to BitGo for making this entire series of conversations possible. And yeah, just a big shout out to Julie for the music selection there. She actually DJs at a warehouse in Williamsburg on Saturdays. So get tickets while you can. No, I joke. Awesome, guys. Thank you so much. I'm really excited to kick this off. We're talking about a macro investor's take on Bitcoin. For those of you who know, who I'm assuming all of you do, Raoul and Dan, you know how rare it is to get these two for 1 hour. So I'm really, really looking forward to this conversation. Before we dive in here, guys, I'd love to just do a quick 30 seconds or a minute from each of you on your background. So Raoul, I'll call on you first if you don't mind.
Yeah, my background, similar to Dan's, is the hedge fund industry for about 30 years. I was at Goldman, where I started and managed the hedge fund sales business in equities and equity derivatives. I then started and ran a global macro hedge fund for the largest hedge fund firm in Europe at the time, and then opted out of the rat race, moved to the Mediterranean coast of Spain and started writing macroeconomic research and investment strategy called Global Macro Investor, which I still write to this day, and that's read by all of the world's kind of biggest hedge funds, family offices, sovereign wealth funds, that kind of thing. And then I started Real Vision, which is the kind of preeminent media business around finance. And that's been going now for 6 years. So I'm the CEO and co-founder of that.
Awesome. Thanks, Raoul. Dan?
Yeah, hi. As Raoul mentioned, we were both in the hedge fund business for about 25 years, worked at various global macro hedge funds, also had my own fund that I launched in 2003, DTAP Capital, which still exists. Worked for some relatively or very well-known guys over the years, and morphed my strategy a little bit in the early 2000s, ended up focusing on not just expressing macro ideas in the portfolios I was running, but then also in ways outside of that portfolio. In 2006, I launched with Stan Druckenmiller, who I was working with at the time at Duquesne Agcoa, which eventually became the largest private farmland REIT in the US. We sold that in 2013 to the Canadian pension fund system. And then in 2008-09, launched a physical gold company, a sales and storage business called Gold Bullion International with a partner. That company today is the third largest vaulter of gold in the world outside the banking system. We've had a great run. It's a fantastic company. It's my plug when people say, oh, I don't know where to buy physical gold or how to do it. it's pretty easy through us, and that company's done a great job. And of course, this year it's been a super year, just a record year off the charts. I came to Bitcoin actually through the gold company. Just to say that in 2014, we integrated with a company called BitReserve, which today is Uphold. And we were the first place you could buy and sell physical gold to buy and sell Bitcoin or Ripple. And then in 2019, the gold company offered, in partnership with Equity Trust, a product for individuals to buy 8 different cryptocurrencies in their IRA account. And we were the second crypto IRA offered in the United States. So, and I'm on the brink of launching a fund now in the next few months called 10T Holdings. And we will be accumulating stakes in mid to late stage companies that are in the digital asset ecosystem. So
Awesome.
that's me. Yeah.
Awesome. We didn't get to the background of how you got that picture, which is your background. Maybe if we have time, we'll get there at the end of the webinar.
I know. It's yeah, as I was saying, I mean, I got it at an auction, but it was, I got trapped into a bidding war, and that might have been the last auction that I will ever bid in, at least for paintings, because those Christie's and Sotheby's people, they really have it tied up. Anyway, yeah, that's for another time.
All right, we'll leave it at that for now. I don't want to make you relive that. Awesome, guys. Really, really excited. Both of you, I think, to give both of you a lot of credit, have really, really deep backgrounds in both macro and kind of traditional finance. And you've really been kind of leading the charge in terms of educating that space where your background is on kind of both gold, but also Bitcoin and kind of the promise of cryptocurrencies. I'd really like to get, later to how you eventually came upon this space and what made you develop the conviction that you did. But first, I'd love to actually start with your view of the macro, right? And once we get your view of the macro and, your kind of outlook for today, we can get to, the whole, how Bitcoin connects to that. So Raoul, I'll actually call on you to start us off here, because I think you had a great kind of framework for looking at the macro and kind of a post-COVID phrase that you outlined a little while ago. So if you wouldn't mind just kind of kicking us off with that, and we'll take it from there.
Yeah, I mean, I use a framework based around history of markets, history of economies, to understand how things will go. Now, that's contextual. There's no perfect forecasting model. There's no perfect answer, but it gives you a contextual idea. And I call it the unfolding. How most of these situations play out, and this is a unique one, and I'll come on to that in a sec, is you have a liquidation phase once everyone realizes something's changed. That was February, March, April into May, that whole period of mass liquidation of everything, every asset, offer only. Then you get to a phase that I call the hope phase. The hope phase is when everyone says, well, we've just overly discounted, things aren't so bad, it's okay. That phase usually runs between 3 and 6 months. So 3 months, for example, would have been the Nikkei 1990 between March and June. The S&P 2000 was between March and June, 2001, sorry. The S&P 2008 was between March and June. And then you have these episodic periods that can be longer. And the one that was more obvious is 1929, where after 6 months it peaked. Also 2002 had this secondary hope phase. So what follows the hope phase is a realization that growth is not returning as fast as people expected. So in this particular case, we knew we had a very sharp drop. We knew that this quarter was going to be very strong because that we're using Q-on-Q comparisons. But once you get to year-on-year remains negative. And as stimulus has slowed, COVID has risen again in Europe and in the US, growth just slows again or stays stagnant but below zero. And normally that's okay. That's part of the recession process. Most recessions take about 18 months. Some take 2 years, some a little bit shorter. But what makes this one unique is we went into this with really record debts. And that's both at sovereign level, with foreign borrowers as well in the corporate sector, corporate debt, very large household debts, all of that together with the only episode that any of us have lived through where revenues, I mean, the only time we saw something similar was the Asian crisis, where revenues have collapsed. And revenues, particularly in the service sector, are not coming back fast. So What happens is, if you've got high debts in a disinflationary, deflationary environment, the real value of those debts goes up and your revenues are down. So after a while, slowly but surely, those 2 points meet and you run out of money. And that's what I call the insolvency. Normally, we don't have big insolvency events. We may have a crisis event, so the banking crisis, that was mainly liquidity that happened in 2008. Solvency is different. It tends to be slower, grinding, accumulates, and then it starts spitting out more unemployment, which spits out lower growth, which spits out behavioral changes, which spits out more insolvencies. So it tends to go on longer and it's very hard to maintain. It's very disinflationary or deflationary. So that's the phase I think we're going into. It means different things for markets. Who knows what it means for the tech sector? People want to ascribe, SaaS business models as zero coupon bonds that can go up infinitely. Maybe that's true. I don't know. I look at the things like the banks every day. I look at things like emerging market currencies. I look at stuff like the oil price, and they're all saying the same thing. Same with the share price of General Electric, AT&T, all these big borrowers. They're all doing the same thing, which is slowly but surely rolling over, and bond yields are doing the same. So it seems that part of the markets are speaking to my thesis. There's another thing that's going on with index funds and everything else. And I think that that is possibly the distraction. And within all of this lies Bitcoin and gold, because they have no debt against them. They are a stepping out, an escape of the system. And the only answer we have to a solvency issue is more liquidity. Whether that's via fiscal stimulus paid for by the central bank or central bank liquidity. And that is the factor that something like Dan and I will get very excited over, because there is almost only one outcome. Unless this miraculously gets solved, there just has to be more. And that just makes things like Bitcoin and gold very attractive. So that's basically the macro backdrop from my perspective.
Yeah, so I mean, one thing that I feel like people are starting to talk about again, which is kind of a classic sign of a top, is, are things different this time, right? And you actually have some people who are saying things really are different because of what's going on with central banks. So Dan, you called out a couple of the, you called out Stan Druckenmiller that you've worked with in the past. You have a rich history in this space. You've worked with guys like Julian Robertson, Steve Cohen, Michael Steinhardt. You've been in this business for a long time. You've seen a lot of different market crashes, the ups and the downs. What do you think? Is this time really different, or are we going to see, is history going to repeat itself or at least rhyme?
Well, I mean, let me just address Raoul's view for a second, because I don't have, and we haven't had the same view on this yet. We've had the same position, which is very strange in a way. This reckoning he's talking about, look, I think March is as bad as it's ever going to be. I don't think we're going to see anything like that again. The entire U.S. economy shut down to zero. Everyone in virtual panic. That was it. And look, we may have a slow period again. The markets could correct back. We could miss expectations, as Raoul said, but it's not getting worse than that. That was it. And one of the reasons is that, look, there was a surprise component to the collapse in March. If we have the authorities are all on, they're all on guard. I don't think, you'd have to have something attack the global economy that was more of a surprise and do more damage than what happened in March. And it just, I've never seen anything close to that, nor has anybody. And, if you look at the charts, the data on the charts, we're not going to be able to look at economic data properly ever again, because these spikes down and back have ruined, the ability to do proper analysis on these charts. I think that was it. If we do have, a problem, going forward, a slowdown or another bolt out of the blue, I just think that the authorities will all, and this is the key point, they will sacrifice the dollar before the U.S. equity market. So the dollar is still high enough and strong enough against all the currencies in the world that if it really came down to it, okay, they would ease aggressively enough to weaken the dollar. And it doesn't have to be a crazy weakening, like a 20% drop in a month or something. You know, people forget that the euro went from 80 to 160 between 2000 and 08. It was an 8-year period. The euro doubled, doubled, and the dollar dropped. And I think we could have another period like that. I think we're at the beginning of a big bear market in the dollar. And that, if it happens gradually and in a trend way, I think ends up being fine. It ends up being supportive for equity, and then of course for gold and Bitcoin as well. So that's my sense, is that, you know, when something happens that is dramatic as that, people are on guard. And so I just, you know, we got scared. We're still, you know, just coming out of it. There's a slow a movement out of this period. The money supply, the M2 numbers, the year-over-year number. I've posted this chart on Twitter a few times because it's probably the most incredible chart of any of the charts I've seen in my entire career. Because, you know, you never have M2 growth go over 5 or 10%. All of a sudden, it spiked up in a 3-month period to 24%. I understand that's a year-over-year basis, and on a, you know, month to month, it may be slowing a little bit. But the point is that what's happened now is it's completely outside of any macro analytical framework that we've used in the past 50 years. And so there's a tremendous amount of uncertainty. But, you know, I think the thing we can count on is that uncertainty is causing a sort of, I don't want to say panic amongst the monetary and fiscal authorities, but it sort of is. You know, we have higher unemployment than we should. You know, a lot of people are still hurting. And so the desire to keep rates at 0 and fiscal policy very stimulative is going to last for several years. And, you know, the do whatever it takes mentality, I think, is embedded. And if the equity market falls back, you know, there is one reason, I think. I mean, the election of Biden would be very negative for the U.S. market. They plan on raising capital gains tax, long-term capital gains, by 20 percentage points. They're going to raise corporate tax. They're not business people. They're reallocators. They want to reallocate wealth from the productive sector to everyone else. That will not be good. So, you know, if there's a shock surprise, you know, I think it's less that COVID rears its head. It's more that the U.S. has an anti-capitalist administration. So anyway, and in that situation, I still think if the equity market fell back 20, 30%, you would still have the monetary authorities coming in, and maybe, you know, maybe that would be the beginning of more of a real kickoff in the dollar drop. So, you know, I would say that sort of encapsulates my view. I don't have this debt liquidation view scenario. I think, you know, we're past that.
Although I must admit, Dan, for me,
yeah,
is, you know, I don't think things get necessarily worse. Do equities go lower? It doesn't really matter so much for my construct. All I'm saying is the one element we've not had before is the length that this goes on for. It creates just negative GDP. Now, it could stay negative 5% for another year.
Yeah, but Raoul, look at that chart. We've never had money supply grow like this. We've never had $25 trillion injected.
Yeah, doesn't drive liquidity, doesn't drive solvency.
We've had $25 trillion injected into the world economy, fiscal and monetary, if you add up everything. And I've posted this a few times as well. $25 trillion. So we added an economy the size, larger than the size of the US in this period of 3 months. So I think, you know, I just think that changes things. I'm not saying it's for certain, but I think that if you're using a framework or an older framework that says we have a lot of debt, things are slowing, people will fail on their debts, to me, it just intuitively feels like the wrong framework.
Yeah, I don't see it because I look at the European banking sector, the US banking sector, nothing looks good. But what's interesting, and you and I have talked about this.
Hold on. The European banks have been basically where they were in 2008 since 08. I mean, they've been a zero. I mean, the total market cap of all those companies is irrelevant. I mean, Amazon's performance in the last 6 months is probably more than the value. Those companies have already been written off to zero. I mean, they're below where they were in '08. And the US banks.
Yeah, but the problem is almost all corporate lending in Europe is not in the corporate bond markets from the banks. And that's a problem, right? If the banks aren't functioning because of the state. But what's really interesting about your and my view, and we've talked about this between us, is the fact that, let's say I'm a complete idiot, which has been proven to be the case many times, and it's a massively inflationary situation, right? Let's say everything is fine, GDP growth is going back to 2%, and now you've got excess stimulus, okay? So that will be the counter view to mine.
Wait, with excess stimulus, you're going to be a lot higher than 2%.
Yeah, well, all I do know in that situation is gold and Bitcoin go up.
Yeah.
And in a disinflationary, deflationary world, the likelihood is the only outcome from central banks, as you said, is to do more. So gold and Bitcoin go up. So it's a really rare situation where we can have completely opposite views and just say, yeah, the outcome is still the same. There's one trade.
Yeah, I agree. I mean, my thought would be that maybe in the very short term, because of Biden risk and because the market's rallied a lot since March, maybe the equity market can correct a little bit. But on a 3 to 5 year view, I think the equity, and again, led again by tech, continues to go up. I mean, look, COVID has accelerated a lot of things, and I'm sure you've touched upon this in some of your other talks and some of the things you've written. You know, the work from home thing, I think, is permanent. Decentralization, decentralized organizations, people getting more used to, you know, Zooms and tech and making important decisions, not in an office. You know, I think that's all, that's all changing things permanently. So you can have a situation where no one wants to give capital to a bank, which is still stuck in, let's say, 1985 in terms of its business plan, with all its brick and mortar and people coming into the branches and writing checks. And who would want to give money to that? They're not innovative in that space, versus people saying, look, I have an unlimited amount of money I want to give to, a Jack Dorsey, right? So it's, I think there are a whole bunch of things going on at once. Look, I think it's the most exciting time from an investment perspective, really, of my career, just because of how much is changing, at the same time.
Totally agree.
Agree. I mean, and then there's the generational shift as well. It does feel to me like, it's a slow handoff to this younger sort of under 40 group, and that sort of the older crowd, if they haven't been totally zapped of energy by COVID, they're not really that open-minded in terms of learning new things. A 70-year-old isn't really going to learn new things about technology. They're not quite adept. I mean, I feel it being in the middle of that group. It's a tough thing. Even for me to get this set up here on the with the camera and my speaker and all of this thing. So I can't imagine, that's very basic. So, that's another reason why I'm not bearish on the equity, and why I think in the next, 3, 4, 5 years, we're going to be in a very strong bull market, because there's so much new out there. And that goes without even talking about Bitcoin and the digital asset ecosystem that's growing up. So
it sounds like in terms of the exact layout of the situation, we're not in perfect agreement, but we are in agreement about what the trade, right, or what the real opportunity is, which is gold and Bitcoin. So again, Raoul, I'll kind of call on you here. I know you've been a gold bull for a long time. Can you just talk to me a little bit about how you view gold and its role in the future, and also how maybe the gold thesis kind of led you into Bitcoin?
It didn't really. Gold, I'm a macro guy. I grew up, gold has always been one of the assets that we buy and sold. I've never been a gold holder. I've never really cared. And as the world got more extreme in its monetary printing, I started looking at gold versus a basket of 27 global currencies and suddenly noticed that it does really well. It does its job. It maintains some sort of purchasing power. It doesn't go up as fast as the largest central bank balance sheets, but it does a good job. And, Dan set up a business exactly based on this premise back after 2008, seeing this was the case. And, all of us macro guys have known this. So that was nothing new. Bitcoin was much newer in that. Gold, we just understood, was a form of money, and we could allocate into it and out of it. Bitcoin was a whole different beast when we got into that. I don't know if you want to get into that yet, or get into that in a bit.
Yeah, no, let's get into that now.
And interesting enough, Dan and I were kind of being part of this journey together, actually, because I had written about it, observed it back in like 2011, 12, and started trying to get an intellectual framework, macro framework around Bitcoin. So I wrote some articles about it. I'd invested, been in and out, went up 100% in a month, and I closed it out the first time. I was like, whoa, what's this? The second time, Dan was there that time. We were at a round table, I don't know whether it's in Cayman or Spain, wherever it was, and a good friend of ours, Emil Woods, sat down and told us why we need to think about Bitcoin and what was going on with blockchain. We didn't know what blockchain was really at that point. And he laid out this whole thing, and we were like, holy shit, okay, we didn't really realize that. So next minute, I buy Bitcoin at 200. It goes up into the 2017 rally. I held it for a period of time. I think Dan may have participated in that as well. And then I closed out early after making a 10x because this forking was going on with Bitcoin Cash. I'm like, I don't understand this. And I don't know if it's going to have adverse effects. Obviously it didn't, but it spiked up and then collapsed again afterwards. I then went quiet on Bitcoin because macro really picked up. So I was really focused on macro, and this really annoying guy called Dan Tapiero kept calling me up, sending me messages saying, you need to look at Bitcoin. I said, Dan, it's macro, there's stuff going on. He goes, no, you need to look at Bitcoin. So this conversation went on for 6 months, I think, or 4 months of him pestering me.
Q1 19.
Yeah.
After the collapse, Bitcoin had gone right from 19 to 4,000. And that, as macro investors, we know we've traded lots of blow-offs. And after a blow-off, you have an 85 to 90% correction. And either the thing goes to zero, or that's sort of the buying opportunity for the rest of your life. And so that was when, I started really digging in, and I needed help. I mean, I really needed help. I was digging in and not understanding things and just reading and reading and reading. And Raoul was a little focused on some other things, but I did. I mean, I must have peppered him every single day for certainly weeks and then months. And then I'd give him a little break and come back. And I was, asking for his opinion because he was more knowledgeable than I was. And so, it was that sort of iterative process that I think, I poked you to sort of get focused back on it again. And then we did that after 4 or 5 months, we did that interview on Real Vision.
Which was great because we both managed to get our thinking across and build on it. And that became, one of the key methods of communication for the whole sector was that video that you and I did, thinking through, okay, what is this thing that we're looking at? And I think it really massively, your thinking had come on so much from where mine was at that point, is I think it just massively moved everybody forwards. I
think that the difference with that was that, we both really are global macro investors. I mean, we both trade as well, but I think if you ask Raoul, and I would say this, all of our profits in the last 25 years probably come from 10 big bets, basically. And, you can spend your life doing trading and back and forth and all of that. But at the end of the day, and it's pretty much like that for most of the big fund managers who I work with, even the more trading oriented guys, it always comes down to they do the analysis at the end of the year and they find that 80% of the money came from 2 or 3 big bets, and they're wondering, like, why am I doing anything else? And so, having that big picture perspective, I think was sort of rare for the Bitcoin space. It's so interdisciplinary. The first 5 or 6 years, I think it was mostly filled only with, people with more of a VC technology bent. certainly no one from the currency world, right? It was more of a, more of a interesting technology. No investor, trader, economics people knew how to mine Bitcoin off their laptop like Emil. And, it just wasn't anything that we had any facility with. And Emil's he's about our age, maybe a little younger. And I think there's a very strong generational aspect to this as well. The younger guys, they take to it more easily. They're more facile with the technology, but they're not as macro. They don't have as big as long a macro knowledge and history. And I think that was sort of the new thing, was to see that this was a security network. And, Michael Saylor was talking about this the last few days about, how important Metcalfe's law is. And, the value of the network is really sort of like the new valuation. It's not new, but like the way that, we're coming up with ways to value, technological businesses, right? And I think that when you start to think about the Bitcoin network and what's been built and how phenomenal it is and how powerful and big and how decentralized. And I kept thinking to myself, look, this seems to be worth this could be worth a lot of money. Just forget about the idea of Bitcoin. Just think about the security network. Like, how much would it cost to build that, right? And you have a company like Amazon, okay, does a lot of things. It's great. It's now $1 trillion. I don't know, maybe how much is the market cap now? Well, certainly. And I started to think, well, it could easily, it's a global phenomenon, right? It's not just a company. It's, it almost like springs from nature in a sense. And so, what could that be worth? And you start to just try to put some valuation metrics around it, and you easily can get to a few $1 trillion. Like there's no, and that's sort of what really got me super excited. In fact, and I would say this, I think people in the space who call Bitcoin digital gold, I think actually undersell it, because gold is a store of value and it's an excellent hedge for your portfolio. And I think today it's just it's in the early innings of a bull market, as portfolio managers, institutions, I think for the first time think about gold in some part replacing some of their bond exposure, their treasuries that are yielding 20 basis points that are supposed to hedge the equity portion of their portfolio. I think that, they're becoming an unproductive asset class, and they're starting to think of gold as that potential hedge, which has no limit on the upside, where bonds, I think, are limited by the zero line. So, so I think, now I've lost my thought. I went into the gold, I got excited to get into the gold, and I was talking about Bitcoin, the value, the network effect. And so I think, it's early for gold in that sense, but realizing that Bitcoin, has its place in an institutional portfolio, which we read about. Fidelity came out just yesterday with a piece. I think that's even earlier, and I think Bitcoin is probably, as I said, a lot bigger than just an asset in a portfolio. It's an entire network, and it has the potential, to be the value protocol for the entire internet. So just calling it like a replacement for gold is too small. It's not just an $11 trillion asset. It's much, much bigger. And, again, we're macro guys. We've for 30 years are always thinking about, super big events and phenomena, almost like historic events. And all of a sudden you see this as, wow, it's bigger than gold. And it's interesting because you have, the Winklevoss and Barry Silbert, they're always talking about, oh, it's digital gold. That's a great idea, I think, for people who aren't in the space or who don't have Bitcoin to think about it. Like, okay, digital gold, I get that. but by imposing that kind of, I don't know, description, or that meme on it, I really think is limiting. And I'm saying this. I'm saying this as a gold guy who's been trading it since the early 90s and has a gold business. And I love gold, and I think everyone should have it. But Bitcoin is this much bigger other thing.
Yeah, no, how I've talked about this is, it is this pristine reserve assets, all of that, and it's also a call option on the future. And as you say, that future could be huge. And so you get a very different risk profile to gold. It's kind of gold supercharged. It's like a 3x super leverage ETF of gold. So it's very interesting in its skewed risk reward. It's incredible, because even vol adjusted over the last 2 years, it's outperformed gold vol adjusted too. I mean, it's outperformed everything on almost every metric you can possibly look at, including it's the only asset to have outperformed the G4 central bank balance sheets, and it's killed them. Not even just outperformed. It's amazing.
Yeah, look, I mean, I think, Paul Tudor Jones said it very well in his piece that he wrote. I mean, the fastest horse, and that's become a meme on Twitter. I think that is right. Gold can double. I mean, I think in the next 5 years we could see 4,000. But if gold doubles, I think Bitcoin is probably a 20 or 30x. Yeah. But what's interesting about that is that gold doubling turns it into a $22 trillion asset class. Bitcoin going up 20x turns it into a $4 trillion asset class. So Bitcoin is still going to be much smaller than gold for a long time. And when you talk about network effects, the greatest network effect of any asset in the history of the world is gold. Gold is something that every single person on the world in the world knows. They know air, they know water, they know sun, they know gold. And I think it'll take a long time for it to lose the value that's been accrued to it. There are also a ton of other reasons why, but for a larger institution facing the zero yield, negative yield situation and having too much in their bond portfolio, they can't do enough Bitcoin. They all can't do enough, and so they will go to gold. I'm not crazy about this. They'll go from zero allocation to 5%, and maybe they'll go initially from zero Bitcoin to 1%. But you have a $1 trillion asset manager, putting 1% in Bitcoin. You have a handful of those, and there's just not enough liquidity to do that. I understand, like, yes, Bitcoin for the average person is a big market, it's liquid, but for global institutions, it's not. So I think that there is and will continue to be a place for gold, even though Bitcoin is the fastest horse. And I don't think that very big vision that we have of, it's a lot bigger than gold. I don't think that I don't think it can get realized that quickly. Like Bitcoin at 20 trillion, which would be the equivalent of where I think gold is in 5 years, is just too much. It's too fast, too big. And the one thing Raoul and I know about being macro focused for so long is that time is the trickiest component, right? So, to us, it seems like it might be right around the corner, but Raoul was bullish in 2011 and then became bullish for different reasons in 14, and then became bullish again for different reasons in 19. So, the narrative can morph. Yeah. I still don't see, even with it morphing, how we get to 20 trillion.
Not yet. Not yet. It's going to take some time.
Too big.
So guys, I want to just tie it back here for a second. So on the one hand, Dan and Raoul, I'm listening to you guys talk about Bitcoin, and it's very exciting, right? Potentially a once in a generation sort of opportunity, huge paradigm shift, all of that kind of stuff. And yet, the kind of some of the other big macro guys in the space, kind of the Novogratzes of the world, have been saying for a long time, the institutions are coming, And we've seen promise there, you know, the Saylors of the world, the Jack Dorseys of the world, but for the most part, we're not there yet. And I think even public perception, when you remove yourself kind of from the macro bubble, the crypto bubble, most people are still like, what's this Bitcoin stuff? And I think, Raoul, you actually said this in that video with you and Dan a little while ago. You know, part of the reason is people don't really understand the problem. Nobody's out here talking about fiat currency. Most people don't really deeply understand what that is. So what I'd actually like to do with both of you, now that I have you on this chat, is get you to answer some of the most common objections to Bitcoin. And maybe some of the folks on this webinar can use these as a resource the next time they inevitably get asked one of these potential problems and objections to Bitcoin. So I'll kind of alternate between the two of you. Raoul, I'll pick on you first, and if one of you feels strongly, you can kind of chime in. But I think one of the difficult objections with Bitcoin that we get a lot is, okay, this is great, but how do I value this? Really, there's no way to value something like Bitcoin. And that might seem really basic, but if you're, you know, an allocator and you're looking for a strategy, not being able to at least put some fundamental valuation around Bitcoin is really difficult to kind of wrap your mind around. So how would you address that objection?
There are some valuation models that are out there. The stocks to flow model is a useful guideline. I think Metcalfe's law is a useful guideline. There's a number of ways of getting an understanding. The same way we had to grapple with an understanding of what's Facebook worth. You know, none of us got this right because we didn't understand it yet. And so I think there are valuation metrics that are there. I think understanding the relative valuation of its market cap versus gold versus other asset classes gives you another understanding of where it could be, should be, and where it's potentially going. So I think for an asset allocator level, there's enough information to say, is this asset undervalued and is its trajectory likely to be higher over time? Now, sure, they might reach an opposite conclusion for one of the other reasons like regulation or whatever is going to come up in these questions. But by most metrics, unless something dramatically changes, this thing is almost unstoppable in its direction. And that, you know, so I think that's all they need for the time being.
Yeah, Michael, I would agree with that. Look, you know, 4 or 5 years ago, you know, there wasn't that much information out there. Even in the last 18 months, there are quite a few very good things that have been published. Gabor published something from you know, Van Eck that I think is very good. The Fidelity piece that came out is very good. If you read some of the letters that Dan Moorhead has put out, or you know, Mike Novogratz you mentioned, you know, the case for Bitcoin, even Cambridge Advisors, which is a very, you know, traditional group, you know, even they have suggested a 1%, you know, or 0.5% or whatever allocation to Bitcoin is not a bad idea. So I think that's changed a lot in the last 18 months. There are plenty of really valid, well thought out cases made that the diversification and alpha that's offered with a very small position in Bitcoin is well worth the risks.
My only problem is within this is people are not yet speaking the language of pension funds and asset allocators. We need to start talking in terms of BARA, you know, portfolio construction tools, all of that stuff. Once we start speaking the actual language of the asset allocator, they'll start to understand the portfolio diversification effects and the beneficial effects. Right now, there's still too much screaming about independence from the monetary system, blah, blah, blah. None of those guys care about that narrative. What they care about is, can I reach my investment objectives by adding Bitcoin into their portfolio? Nobody's really speaking that yet. It'll come. I'll force somebody to write this up properly because it needs to happen. It needs to be spoken in terms that those guys understand. They shouldn't need to come and understand our terms.
I agree with you. All right, the next objection, Dan, I'm gonna direct this to you first. So people say that Bitcoin isn't backed by anything. And I'll actually double down on that. Maybe the more nuanced argument there is to say, obviously one thing that gives currency value is its demand, right? The balance of supply versus demand, but there are also legal protections, right? That are afforded. For instance, the US government can say, hey, you need to pay your taxes in our dollars. So what would you say to that kind of common objection of Bitcoin?
Well, which specifically, that the regulators will be involved, or what specifically?
Yeah, I guess the argument that the regulators might get involved and potentially shut the whole thing down.
Yeah, you know, that is the most common question that people bring up. And I think that, look, all of these questions are frankly solved by just hard work. And, the answers are all out there. That's what's incredible, is that everything is online somewhere. And, look, I grew up in a time when there was no internet. Like, I had to spend, I studied history in college. I had to spend, 2 weeks in a library looking for one book. Okay. And so these objections, if you do your homework and you dig down, it's all there. You just have to do the work. And so, look, I mean, Bitcoin, it's so decentralized. I don't think it matters really if anyone shuts it down. I think, look, the UK the other day made something, what was it? Made Bitcoin derivatives illegal. And people are like, oh, that's going to be a problem. That's no problem. BitMEX had an issue. Oh, Bitcoin's in trouble now. It's no problem. Bitcoin, maybe in the first 3-4 years, 5 years, it was still kind of, I think, in its infancy, huge volatility, lots of different narratives. No one really sure exactly what was going on. People thought it was cool. I think the narrative in the last 18 months is really cemented. And, look, if you look at the hash power and you look at, look, what supports it, the proof of work algorithm, right? And the amount of energy usage, the hash rate growth rate has continued to go up. Bitcoin is more secure today than it ever has been. And so then the next thing is, well, okay, explain the proof of work, explain all of that. And the point is, you're supposed to do your own work, right? Like you can say a few things and say, what's it backed by? Well, it's backed by tremendous energy usage. And people will say, oh, well, that's bad. It's eating up the economy. Well, 75% of that is renewable, right? And it's actually, and there are pieces that have been written on this. And guys a lot smarter than me, a lot deeper into the space. Some of these younger guys, the level of knowledge, in-depth knowledge, is just incredible. And so it's all out there. Raoul and I aren't making these crazy claims because we need any attention. I don't particularly care one way or the other. I think this is a phenomenal invention. I think that the world will be better off once it comes to realize its power. Look, if I were, and I've said this before, if I were and I know it's sort of outside the Bitcoin, realm, but if I were in the US government, I would be doing everything possible to help Bitcoin grow in the US, to have people understand it, there will be, livelihoods improved, jobs improved, performance of pension funds improved. Like this all goes back to us. Instead of in the US, we've sort of taken a little bit of a negative outlook on it. And there are very few legislators who understand what it is. So here we have this thing in our midst. We've got some great companies here that are growing up in the ecosystem around the adoption of Bitcoin, cryptocurrency, blockchain, however you want to call it. I think people are still figuring out how to describe it. But we should be doing everything in our power to encourage the growth in adoption. So, I just think it's hard work. That's all. For me, it was 6 months of about 10 hours a day of reading after having known about it for 5 years, right? And Raoul has sort of come into this new level of conviction, after years of thinking about it. So I'm not saying it's easy, but I think it's going to be worthwhile for people who do the work.
Dan, you're absolutely right. I was trying to cheat and pick your brain, having done all the work for the benefit of everyone else here, trying to offer shortcuts, but you are absolutely right.
It's very easy. You can just put that question into Google and read the first 5 things that come out, yeah.
So I guess, just to wrap all of this up here, and then we can actually get on to the audience questions here. But I think you're absolutely right. But in one way, what you're describing is one of the biggest barriers to Bitcoin adoption overall. precisely because it is such a big idea and you need to invest so much time and personal education to get an idea of what's even going on here. And I think I've heard both of you say as well, one of the outcomes that happens after you invest all that time is you kind of come away with this idea of, oh my God, I'm looking at this incredible opportunity. And you start saying these loony things like paradigm shifts and it's all going to be different. And it sounds crazy to the people who haven't done the work. So both of you guys are guys that talk to an institutional audience. For you, what have been some of the most effective ways of communicating why Bitcoin is valuable to someone who hasn't done the work yet?
I think everybody's going about it wrong if they think about the holy shit moment for everybody. It's irrelevant. I think what Dan said is the network effect. Network effects don't happen overnight, they happen bit by bit. It's the whole value of the network building its own value. So that's everybody getting more comfortable, talking about it more, you hear about it more, you want to look into it more, you find a bit more, and it's the same as everything else. And so I don't think we need we need the proper branding tagline that everybody get. It doesn't matter. Let everybody explain it in every different way that they want, because it'll bring more people in. And that is the value of the network effect. With institutions, it's very simple. Firstly, learn to speak their language. I said barra models, things like these things that we don't talk. Even Dan and I don't talk. They're alien to us. But we need to talk to them if we want to get them involved. We need to show them how it helps them. And then there's a bit of magic that happens. They're all sheep. So they're basically all short the upside, and they know it. And I know it, and Dan knows it. Because the more that market cap goes up, the more they get forced in. So even with no justification, if it's $1 trillion market cap, they'll have to do some, because their trustees will say, why didn't you have it? So the market is short, structurally short calls. It is one of the best setups I've ever seen in anything because of this. Because they all know about it. As Novo says, well, it's one of the best brands on earth. Everybody's heard of it now that matters in this community. Nobody hasn't heard of Bitcoin. So now it's a matter of Coke versus Pepsi. Do you get them to have it or not? And over time, the power of that network effect and the power of the market cap going up makes them all have to follow each other into it. It's a beautiful thing. You get to front run all of the institutions on earth. And for once, retail wins.
Yeah, that's true. Yeah. Well said.
Awesome. Anything to add there, Dan, or can we go into, we've got about 5 more minutes left here.
No, he said it perfectly. Yeah.
Perfect. All right, guys. Well, thank you so much. We've got about 15 different audience questions here and probably not enough time to run through everything. So just, I guess, as quickly as
the hardest one to answer.
The hardest one to, all right, well, this one is addressed to you. So I'll call on you there. I'll call your bluff. Could Raoul comment on Dan's take on reallocators and the potential impact of increased capital gains from a macro perspective, as well as Bitcoin specifically?
What is that?
Sorry, I don't even understand.
I think this was a reference to Dan's comment about Biden not being a business guy, but a reallocator, and they want to reallocate wealth.
I've lived through, being a European, I've lived through high taxes, low taxes, tax cuts regimes, tax rates. It makes no difference. Markets will go up. If it affects markets, as Dan said, over a 3-month period, things adjust, companies adjust, everybody figures out a new way. Whether the marginal rate of tax goes up over time, adjusted for things that they discount it for, who knows? Tax is not my driver of asset returns. I say that as a caveat. I'm living in the Cayman Islands and I don't pay tax. Just so people are aware of that.
Yeah,
exactly. I mean, look, I think it'll be negative, but it could be 3 months, but it could be a year. So yeah. I'm a little, look, you have to understand there are huge gains that have been accruing to people who own businesses and equity as well in the last 5-10 years. And we've been paying 20% long-term capital gains. So if you're telling me that Jan 1, I wake up, all of a sudden it's 40%, and I've been building a business for, 10 years, my profits on the sale of that business, I'm going to lose 20% of it, immediately. I just think that's one aspect. And the other aspect is, look, if there are higher corporate taxes, then companies will make less. So that'll have to be discounted. I also, look, when you hear things like Liz Warren could be Treasury Secretary. Again, I don't think that's going to be the case, but I mean, that's a crazy scenario. I mean, that group of people are not really equipped, in my opinion, to run the economy in a way that is best for shareholders and business owners. So yeah, but Raoul is right. That's why I said before, I have a stronger sort of 3-year, type bullish view on things, because I think it could be a little bumpy. But I'm not sure. It may not have that much impact. You could argue it might be good for gold because if things do slow down and the authorities have to continue to stimulate, dollar starts to weaken, rates even potentially go negative. That'll be good for gold and Bitcoin. It's a very good setup for them longer term. And by the way, I don't think either of us are actually trading Bitcoin. We have our allocation, we're positioned, and that's it. So.
As a last question here, could one or both of you comment on the recent kind of announcements or purchases from corporates putting Bitcoin on their balance sheet? So examples of that were, what Michael Saylor's done at MicroStrategy, but also Square as well.
From my perspective, look, these are people so deep down the rabbit hole. There is no way that Michael Saylor, and he's an amazing guy, is persuade another corporate treasurer to do it using the framework he uses. Corporate treasurers don't have 100-year balance sheets, all of this kind of stuff. So Michael is brilliant. He's completely got into the space, completely understands it, and I think it's amazing. I don't think it's the argument, but it's coming anyway. The network effect is coming. They all know about it. They've all heard about it. Even at Real Vision, we're looking at allocating some of our own cash into Bitcoin, just because it makes sense. And why not? Because, the risk rewards are so good, it looks like an option. So yes, we will see more. I don't think it's an acceleration point yet, but over time, as the market cap goes up, as I said, the more likely they are to do it. What's the probability of somebody like Apple putting some of its cash in the next 5 years into Bitcoin? Probably something close to 100%. Is that this week or in 5 years' time? No idea.
Yeah, I think it's a signpost for just how early things are. I mean, just think about this. Jack Dorsey, he's at the cutting edge of tech, of this entire world. He has, as everyone knows in his bio, he only has, the Bitcoin symbol, all right? And just think about this. It took him 10 years before buying Bitcoin. 10. And he's at the cutting edge of the cutting edge. So that shows you how early we are. So I have great comfort knowing that. And Tudor is a guy who's early. And Michael Saylor, if you listen to how he explains why he owns it, is exactly the right reason. He totally nailed it. And he took a gigantic position, but it's early, right? These are guys who are at the very, very early stages. Yeah, it's hard for someone to think, who's been on Bitcoin Twitter and in the world for 10 years, and they're sitting there, maybe they bought in 2012, these OG, Bitcoin guys, they're thinking, well, how much longer do I have to wait? Well, I would say, if Jack just bought now, it's early, you just be patient.
Yeah, don't forget, it's like these guys are like Wences Caceres. 2010, he's bleating to everybody in Silicon Valley about this. Yeah. It takes him several years, including Jack Dorsey. He's the guy who seeded Jack Dorsey in the idea. It takes him that long, and then Jack Dorsey. So it's not only 10 years, but it's even longer from when the first seed went into Silicon Valley and spread out of Wences. And we're still, Facebook and these guys haven't even integrated this stuff yet. We are so far behind to go. So this movement, as Dan rightly says, is incredibly early. These are the seed people that hyper engaged early adopters look like lunatics, end up looking like geniuses in later time. But that's how early it is.
Awesome, guys. I want to thank you both so much. That's unfortunately all the time we have. Before we leave you, if anyone on the webinar wants to find out more information or contact you or anything like that, what's the best way to do it?
Easiest way for me is at Raoul, Raoul, GMI on Twitter. I'm always around.
Great. Dan?
Yeah, I've only had Twitter for 1 year, and it's as a result of Raoul telling me that I was ridiculous for not having a Twitter account. DTAP cap is my Twitter handle.
Perfect. Guys, and a big thanks again to Pete and the entire team at BitGo for making this and other conversations like it possible. Again, BitGo has been kind of at the forefront of talking to the institutional participants in this space, and owe them a big debt of gratitude. Thanks a lot, Pete. If any of you guys like this conversation, we've got 2 more webinars coming up very soon. This coming Wednesday, October 21st, we're talking about the next generation of financial products. And then on October 27th, we're breaking down the RIA's guide to digital assets. So all you financial advisors and RIAs and planners out there. Raoul and Dan, thank you both so much again. This was a lot of fun.